is something that's baffling economists and everyday investors alike. Stock markets are soaring to new heights, while the economic foundation beneath them appears to be crumbling. This seemingly impossible contradiction is happening right now, and it's leaving many people scratching their heads. Picture this scenario. Joblessness rates are climbing steadily upward, creating a ripple effect of anxiety among workers who haven't felt this pessimistic about their career prospects in several years. At the same time, the cost of everyday goods and services continues its relentless march higher, putting additional strain on family budgets across the nation. Meanwhile, the country's deficit keeps ballooning to unprecedented levels, and regular consumers are expressing growing concerns about their financial future. But here's where it gets controversial. Despite all these warning signs flashing red, stock prices continue their upward trajectory as if none of these problems exist. What makes this situation even more puzzling is the enormous cloud of uncertainty hanging over some of the most critical economic policies. Nobody knows for certain what will happen with the trade tariffs that President Trump has been implementing, or when and how the Federal Reserve will adjust interest rates next. These are massive decisions that typically send markets into wild swings, yet stocks seem almost immune to this uncertainty. This disconnect raises some uncomfortable questions that most financial experts don't want to address directly. Are we witnessing a market that has completely lost touch with economic reality? Is this the calm before a major storm, or have we entered a new era where traditional economic indicators simply don't matter anymore? Think about it from your perspective as someone trying to make sense of their financial future. If unemployment is rising and inflation is eating away at your purchasing power, shouldn't that mean companies are struggling too? And if companies are struggling, shouldn't their stock prices reflect that struggle? The traditional logic suggests that when workers lose confidence in the job market and consumers tighten their belts due to rising costs, businesses should see reduced demand for their products and services. This should naturally lead to lower profits and, consequently, declining stock valuations. Yet the opposite is happening. Some market observers argue that this phenomenon proves the stock market has become completely divorced from Main Street economics. Others contend that investors are betting on future improvements that haven't materialized yet. And this is the part most people miss. There might be forces at play that aren't immediately visible to the average observer. What do you think is really driving this puzzling trend? Are we looking at the early signs of a dangerous bubble? Or is there a logical explanation that makes this all make sense? The answer might depend on which economic theory you subscribe to. And that's exactly what makes this situation so fascinating and potentially explosive. Does this disconnect between market performance and economic reality concern you? Or do you believe there are valid reasons for stocks to keep climbing despite these challenges?